Good morning. I'm John Kosar with your Beyond the SEAF Model video. I'm filling in for Jack this week, who's on vacation with his family. Let's get into the Research Center and have a look at the newly updated SEAF Model graphic. And here we are. So we see this week, economically sensitive energy, XLE, is for the 9th time in the past 10 weeks, the SEAF Model's top-ranked sector with a ranking score of 4. And just for those who may be new to the SEAF Model, the SEAF Model is an idea that I originally developed probably 6 or 7 years ago when sector rotation really started to speed up. And just observation of relative performance it just wasn't good enough anymore. It was missing too much of these moves that really became smaller. 10 years ago, you would have, the norm would be you'd have a sector that might outperform for 1 to 2 quarters. Not the case anymore. You can see how quickly the sector rotation has been lately. So I developed a methodology to measure the velocity of money moving around the 11 sector spiders in 3 different time frames. We have trading, which is 5 days. We have tactical, which is 21 business days. And we have strategic, which is 63 business days, or a business quarter. So we have a business week, a business month, and a business quarter. We measure the speed of money that's moving around those 11, and we score them in each of those time periods. So you can see energy here across the top. It was the second fastest money that was coming in. This is through last week. And you can see the fastest money out was communication services and technology down here. So we then do it for the tactical and strategic, and we add the scores. So the best score that you could possibly have is if you were number 1 all the way across. And that would give you a score of 3. That's the best possible score of money that is going into a sector. And on the flip side, 33, when you would have 11s all the way across, that would be the worst. And then we categorize them where favored are scores of 3 to 15, neutral are scores of 16 to 24. Those are gold. The favored are green, of course, and the red ones from 25 to 33. That's a void. So again, energy for the 9th time in the past 10 weeks. That's a nice long stretch. And we'll take a closer look at that. We're going to do a little differently than Jack. Jack is really all over the numbers. He's the person that quantitatively back-tested this model, and we tuned it up a little to make it work better, just to squeeze as much juice out of it as we could. He'll be back next week. So we're going to do a little something different this week. In a few minutes, we're going to look at some individual charts and see how what we're looking at here on the SEAF graphic intersects with what's happening on the chart. Meanwhile, our model retains defensive utilities, XLU, as the top 3 ranked sector for the 5th consecutive week. XLU here with a score of 13. And we add cyclical XLB materials right here as our 3rd. The way that we recommend that you use the model is the way that we back-tested it. We've back-tested this thing a lot of different ways, figuring out what's the best way to keep the drawdowns the lowest and to make the most money with the model. And our back test going back 7 to 8 years have shown that buying the top 3. We also trade this. So we have managed accounts. If you are interested in a managed account rather than trying to trade this yourself, that's available to you. You can contact us privately for that by phone call or through the website. But investing in the top 3, and we always invest in SEAF. SEAF is not like CPM that goes from risk on to risk off. This is always in the market. And in fact, oftentimes when the market is going down, SEAF does the best. We've seen that so far this quarter. We've had an exceptionally good quarter, really on the back of 3 sectors. We were industrials for quite some time, energy essentially since the beginning of the year, and we've also spent a lot of time in utilities. Those have outperformed the market, the model has done well. On the other side of the coin here, we've got industrial. Well, actually, let's look at the two avoids. We have communication services and technology is where the money is basically coming from, if you're looking at it holistically, to go into the top three. When energy, utilities, and materials outperform while technology and communication services lag the S&P 500, it typically points to a late cycle, inflationary, and increasingly defensive market regime. So that's the way things are shaping up here right now. Let's change views and look at some charts together so we can see kind of how what we're seeing in the model manifest itself in the actual charts. Let's look at XLE first. We've got that up right now. Up on top, this is XLE and this is daily. Right now we're going back to 2024. I'm going to move this in and out. But when XLE first became a top three, according to SEAF, was right here in on January the 20th. So you can see from January the 20th, and then we got out here at the blue area. We didn't get out, but we moved to another sector. XLE fell out of the top three. So from here to here, we outperformed. Actually, here's relative performance down here versus SPY. So from here to here, we outperformed by 18.3%. You can see we took a couple of weeks off, and then we got back in our current open position here on an overweight since 3.9, and so far we've taken 17.3% relative outperformance. So since Jan 20, we've got a relative outperformance gain of 35.6%. XLE is trading at all-time highs. Let's go to XLU, which is our number 2 ranked. See what that looks like. So here's our overweight right here, and we've got a nice lead here of about let's call it 5.3%, a little bit over 5%. That's relative to the S&P. This is a relative model. So what we're looking to do here is to outperform the S&P by following the money as it runs around the 11 sectors. Here's the price chart. We've been trying to break this resistance level here. This is the October 16th peak at 46.88. You can see we've taken several runs at trying to break it, and we're starting to test it again here. So that's the level to watch. That level again is 46.88. If we can get on the other side of this and stay there, this should open up another run for utilities. Let's look at materials. That's our number 3 this week. That's XLB. And this was interesting to me. A couple of important things are happening. We've got a support level here that's based on the 200-day moving average and some support from these highs. You see it right here. The long rectangular graphic here just shows that this is a major support level. We're starting to bounce off of that. In the meantime, XLB started outperforming SPY on a quarterly basis. This is a 63-day moving average here in yellow. Started outperforming on a quarterly basis on December the 12th. We came and tested that 63-day moving average just about a week ago, and now we're outperforming from it. So this is a nice springboard on the price chart and on the relative performance chart that supports the flush of assets that we're seeing according to the SEAF model. Let's look at the other side of the spectrum here. This is XLK. So XLK technology, after testing its orange 200-day moving average, these are working charts. So they're a bit noisy. There's a lot of lines here. I'll try to point out everything I'm looking at. So this orange line is the 200-day moving average. It's a major trend proxy. Tested it a bunch of times here, really from the beginning of February. We finally broke down. So what does that mean? That means that this is a major trend change. And we also see here that really outside, well, with few exceptions, XLK has been underperforming the S&P since the middle of December of last year. That's the The gold line here is the 63-day moving average. So let's go from this peak. Since January the 28th, XLK has underperformed the S&P 500 by almost 6%. XLK typically leads on the upside and on the downside. So it's really been doing what you would expect in a bear market, in a down market. It is underperforming. And until that changes, it's likely to have an adverse effect on the S&P 500. Let's look at communication services. That was the other one down at the bottom. And you can see here multiple attempts to break this high that we made back in September of last year, failed on every one of them. And now we crashed through the 200-day moving average here in orange, and we're testing this big support level here. The price on that is 105.58. We're testing it. If we hold it, we could have a minor relief rally. But again, the trend is still down. We are below the 200-day moving average here in orange, the 50-day in blue, and the 21-day or monthly moving average here in red. So what we're seeing again on the chart is reflecting the asset flows that we are discovering by following the SEAF model. Note, this has been a relative performer going all the way back to October of last year. It's been a relative performer for the S&P. Hasn't really outperformed, hasn't really underperformed. Finally, let's look at XLI. XLI is interesting to me because we're testing this big support level here off of this high that we made back in October, and the 200-day moving average is right here on the outright chart. And down on a relative performance basis, it is testing its January trend of relative outperformance versus the S&P right here. Let's just take this circle and move it here. You can see exactly where I'm looking at. The reason that's interesting to me is here's XLI. XLI dead last in terms of the tactical, and that's 21 business days. But it's 6 here on trading, and it's as high as 3 on strategic. So this is not a signal. Unless it's in that top 3, I don't want to touch it. But watch industrials because the price chart is setting up for a possible move higher. And we want to see if the market responds with some positive asset flows in the weeks ahead. Just something to keep in the back of your brain. Performance-wise, today's the last day of the first quarter. Through the end of last week, year to date, SEAF is up 8.56% outright, and it has outperformed the S&P 500 by 5.38%. That's a very good quarter for SEAF, especially during a period where the S&P has not done well. Since inception, which is June of 2018, SEAF model annualized performance of 20.5%, outperforming the S&P 500 by 8.7% on an annualized basis. Again, from the middle of 2018 through the end of last week. So SEAF is doing its job. Its maximum drawdown is about 4 to 5% less than the S&P 500. Similar standard deviation, similar beta. This is our evergreen model that is meant to keep you in the market. This is the part of your portfolio, or part of my portfolio. Everything that all of my money in the market is in our own models. And what I use SEAF for is kind of the evergreen spot in my portfolio that always stays invested. And over time, similar or better risk numbers than the S&P 500 with a lot better performance. So that's all I have for you today. Jack will be back next Monday with your next video. Have a great week.